Stocks are lower, I believe, ahead of the closing bell. They've been changing moment by moment. Keith Lerner, Truist Co-Chief Investment Officer and Chief Market Strategist, is joining us now. Keith, it is fantastic to see you after what has been a wild few sessions in the market here. And I know that you took a step back in February, and you said, you know what, maybe we should be a little bit neutral here. I'm curious at that point, what was sort of the catalyst for you? And are you still sticking with that neutral kind of view in the face of what's been going on?
Yeah, well, hey, great to be with you, Julie. You're right. Back in February, when we look at the way of the evidence in our work, it just suggested that the risk reward had deteriorated from where it was prior, where we had been very bullish. And some of the things we had looked at is we already started to see the economy cool somewhat even before this tariff news. We had gone the longest stretch of this bull market without even a 5% pullback. That told us that we were vulnerable. We started to see earnings flatline somewhat. At the same token, when stocks made new highs in February, only about, or say when the S&P made a new all-time high, only about 50% of stocks were making new highs. So we put that all together ahead of all this event risk. We just thought the market was being somewhat complacent. So that's I guess, maybe answer to the first part of your question. The second part of your question, our overall strategy is still somewhat more neutral. But the main thing we're talking to our clients, our advisors today, is that we would not be selling into this panic that we're seeing short term. At least now, you are starting to discount some of these uncertainties. Not saying that this is the end of the decline, but what we're also saying is that that we should be thinking about two-way risk, not just risk to the downside, but there's also risk now to the upside. So it's become a bit more favorable than I would say where it was in February, where, again, we weren't pricing in any risk in that point.
Keith, how are you? It's Kenny Polcari. Let me ask you a question about targets. Now that we broke through 5,000, earlier today we were trading in 49, I think 49.75-ish. I think that was a low, might have been a little bit lower. But now that we've broken that kind of psychological 5,000 level, depending on where we close tonight, where do you see it in short term? Do you see us testing potential a little bit lower? Because I view that, we're not going to have this V-shaped recovery. Things aren't going to rally right back, that we're going to churn for a little bit and maybe just churn a little bit lower. I don't think we're going to have these, down 5 and 6% days like we just had for the last couple of days. I think it's kind of stabilizing. And there are some big name stocks that are actually becoming a value play.
Yeah, well, great to see you, Kenny. So we actually put our note out last night, and what we're referencing more importantly is is around the 4,800 level on the S&P. Right. The 4,800 level is the 50% retracement of the 2002 to 2025 bull market. So if we look at that uptrend to the recent pullback, it's almost a perfect 50%. That level, that roughly 4,800 level, also overlaps with the highs from 2021. So that's exactly where we stopped today. We're at 48.35. So I think that's the important near-term level, Kenny, in our work. And then the other thing I would say, too, is that about the volatility. We put out a note last night looking around at these big two down days in a row. And what the work clearly shows is that volatility tends to cluster. And what's also notable, within the next 2 weeks, not only you go from having one of the worst two down days to having one of the best two up days, meaning it's not unusual to see some type of rally in the 9%, 12% at some point over the next few weeks. It may come up from different levels. So to your point, I actually think that we will see some pretty choppy action. What happens after that shock period, you have this battle between fear and greed. Fear that we have more downside, so people are looking to sell, and those that are more greedy or looking at opportunity to buy. So we create this kind of back and forth, which I think is likely to continue here in the near term.
Yeah.
Well, and I was going to say, we're also getting into earnings, right? We've got JP Morgan reporting on Friday. Are we just now setting up for just a relentless parade of earnings calls where people say, we're not going to issue a forecast, for example, because we are too nervous to do so, or we're going to cut our forecast? I mean, are we looking at a sort of doom and gloom earnings season here?
Yeah, I don't know if you're a CFO or a CEO, especially of a multinational company, I mean, how much clarity do you have? How much confidence do you want to go out with some confidence in an outlook? But here's the reality, though. We've just seen a contraction in the S&P PE by about 3.5% to 4%. We have more than a 17% correction. the market knows that cuts are coming, right? So the question is, how big will they be, and how broad based? Because again, the market is correcting based on that already. So I think what I'm going to be looking for into the earnings season is maybe less about what companies are saying and more, how do these stocks act? Especially some of these ones that have been really beating up, call it in retail, or some of these areas that really have been walloped. When you have a cut, do the stocks react and move higher? That will tell you that more of this news is already priced in. But that's the key in our view. And I will also say on the upside, I still think, and this is a ways away, but I think that 56, 5,700 is really going to cap the upside for some time. So we're going to be in this choppier period for some time.
Yeah, I think, Keith, what are you expecting for earnings season broadly? Are you expecting to see this? I think the growth is expected to be now 7.5%, right? I think it was 12 at the beginning of the year. That's come down to, I think it's about 7.5% right now, is it not?
Yeah, it's somewhere around there. I mean, Kenny, you and I have both been doing this for a while. Like, somehow the companies will come in, and they'll, as far as the beats relative to expectations, my guess is they'll still be around 70% or higher. I mean, they did that through the financial crisis. I think what you'll start to see is this pickup in the guidance, the negative guidance going forward, or the pulling back as well. And probably what you're going to just see is really almost wide swings. Like, hey, this company really has handled this better. They're actually better equipped for this versus, oh, this is more of a surprise. So it's going to be this, wide dispersion period as a whole. And I would say, in our work too, I mean, when we look at these shock periods, I mean, when you look forward over the next 3 months, the risk return is pretty mixed. As you expand your time horizon, looking at a year, 2 years, the probability of markets being higher is much better. So I think in some ways, right now, investors have to start thinking a little bit longer term. I know like that long term is kind of thrown out a lot, but right now, when you have all this uncertainty back and forth, you've corrected, you really want to start thinking, if I buy something here today, there's a good chance that it will be higher 2 or 3 years as opposed to the next 2 or 3 months.
Well, let me ask you this, though. I mean, if we are looking at an attempt by the administration to sort of fundamentally reset the global trade paradigm, is that a longer-term process? Or is that something that the market is, I mean, how long does it take to price in something like that? Something that seems to be such a large and disruptive endeavor.
Yeah, as usual, Julie, you are asking the right question. That's the debate that we're having too, because what I can tell you today is when you're down 17%, the median recessions, the pullback around the typical recession is about 24%. So you're effectively pricing 70%. The question is this going to be just a normal, kind of pullback if we do have a recession? So that's the $1 million question. And I that's also why I don't think this is going to be a V-shaped recovery. It's going to take time. This is a big change from what we've seen in years past.